All right. So now we will discuss accounting for some of the other matters as it relates to leases, right? So there are two other important matters which we need to know, which is how do you deal with accounting for subleasing, okay? And then how do you deal with accounting for sale and lease back, right? So what is sublease basically? If you think about it, it is like let's say there is original lessor is there, right? So essentially, what we are saying in a sublease arrangement, right? So I have a lessor, right? And I have a lessee, and then that lessee in a way further finds another user of the asset. So I'm going to sublease the asset. Okay, so lessee becomes the intermediate lessee in a way. So that we need to understand how do you then deal with. So I'm not the owner of the asset, but I'm allowed actually to let the asset be leased to another party. Okay, so that is called a sublease arrangement. So the key is again from a sublease arrangement, how do you account for that? How do you, whether you treat that as a finance lease or an operating lease, and then what are the accounting nuances around the same? That's one thing which we'll try and understand. The second thing which we need to understand is this whole sale and lease back. Sale and lease back is what? Basically, let's say I'm the owner of the asset and I sold it to another party, all right? And then I leased it back. I've taken that asset back in a lease arrangement from that other party, from that counterparty. That is, I've sold the asset and leased it back, which is sale and lease back. Now, sale and leaseback is, as an example, we commonly see in airline industry, right? So a lot of these airline operators like Indigo, or we have here, right, SpiceJet and others. What they do, they will do the contract with the OEMs, which is Boeing and Airbus, and the Boeing and Airbus will sell the assets or the aircrafts to these airlines, and then these airlines, in a way, may decide to be the owner, or what they do most of the time, they sell this to an intermediary financer. In a way, they will sell these aircrafts to the financer, and then they will lease it back from that financer, okay, for the purpose of use. And the lease back may be for 5 years, 6 year, 10 year, 20 year, depending upon the commercial arrangement between the financer and the airline company. And the financer then try to optimize it by saying that I'm going to lease it to you for some time. Once this is over, then I'm going to lease it to somebody else. And that's what their business is actually principally doing, leasing of aircrafts. Okay. That's the sale and lease back. Now, in the sublease, a common example, let's say, which we see, which I kind of had shared previously as well, is in this whole co-works business, is what we are now commonly seeing, where there's the owner of the building, right? And then there is one large, so to say, tenant or a lessee, which has taken the property on the lease, and then that lessee is actually trying to further then sublease, okay, to a number of small users, okay. So in a way, you're trying to create value. So you lease the asset for, let's say, 100 rupees a square feet, and then you're trying to sublease it for 120 rupees square feet, in a way trying to make some money in the process, and in a way that becomes your business. Or we see it otherwise. Let's say you've leased a property for 5-6 years, and then you're not able to commercially utilize it, and there are severe penalty clauses. Then you want to benefit by way of subleasing it, right? At least recover some portion of your cost. So we will try and understand the nuances around both of them, right? So what's the definition of a sublease? A sublease is defined as a transaction for which an underlying asset, so there has to be again an underlying asset, is released by a lessee, which is an intermediate lessor, to a third party. Okay, there has to be another party, and the lease between the head lessor and the lessee remains in effect, right? So there is an original lessor, so to say, okay, and then there is an intermediate lessor, okay, intermediate lessor, okay, and and then the end user, which is the end lessee, right? So that's where there are become like a three parties in this arrangement, right? And when I look at this, which is a sublease, there's the original lessor, right? Original lessee, intermediate lessor, right? And then the lessee subleasee, and there's a head lease. This lease continues, and that's the sublease arrangement between the lessor and uh, the intermediate lessee in a way becomes the intermediate lessor in a way from that perspective. Okay. So how do you deal with the recognition and measurement for the sublease? Okay, so you have to look at the sublease as whether that's a finance sublease or that's an operating sublease, right? Because the intermediate lessee is actually operating now as an intermediate lessor, right? So he's the owner of the asset in a way in that for that period, and now he's subleasing it. So when you are trying to make an evaluation, the sublease, the accounting for what I am leasing it, how then I become the lessor in that arrangement. So how do I in a way account for it? So in a way, if there are three parties, A, B, and C, so how do B in a way has become the intermediate lessor? So how do B account for it as a lessor? C will account for it as an end user, as a lessee. A is anyway is an original lessor, right? That's how you need to understand this. So lessee often enters into arrangements to sublease a leased asset to a third party, right? While the original lease contract is in effect, where one party act as both the lessee and lessor of the same underlying asset. The original lease is often referred to as a head lease. The original lessee is often referred to as an intermediate lessor or sublessor, and the ultimate lessee is often referred to the end user, basically the sublessee, right? Sublessee. So there's a sublessee, which in my example here is C. The intermediate lessor or the sublessor is this guy B. And the original lessee often and then we have there's original lessor as well, which is A, right? From that perspective, which is this head lease, right? In some cases, the sublease is a separate lease agreement, while in other case, a third party assumes the original lease, but the original lessee remains the primary obligor under the original lease. In a way, you may do two, you may do three kind of stuff. It's a more of contracting, but it has no impact on accounting outcomes, right? So how do you deal with from an interim? So original lessor accounting doesn't changes. Okay, the original lessor accounting, which is A in that example, again, if I look at A, B, and C, right? So A accounting, which is the original lessor, that there's no impact on that. We are largely actually going to talk about accounting for B and the C, right? That's where, and essentially the impact is on B. C is again as very simple, like a lease asset he's taking, which is a single accounting model. You look at right of use asset and liability. So C is sorted. C, there is no problem, right? And the complexity is at B level, because B had taken the asset on lease, which B has decided to sublease, right? So we have to look at the B accounting. When the head lease is a short-term lease, right? When the head lease, which is less than 12 months, the sublease is classified as an operating lease, okay? Otherwise, the sublease is classified using the classification criteria, but it should be referenced to the ROU asset in the head lease, okay? So we're going to then look at if the sublease is classified as a finance lease, okay? If the sublease, which I have given it to the, which the B has given to C, right? If that is to be classified as a finance lease, right? Then the original lessee, which is B, will designate the ROU asset on the head lease at the sublease commencement date, and will then record that as a net investment in the lease. Okay, so the character in a way changes. Okay, and the also you will evaluate if there is any impairment loss or a gain, because essentially you have changed the character of the ROU asset to an investment in the lease, and there could be some potential gain or loss if it is a finance lease, right? From that perspective. Now, if it is an operating lease, then essentially nothing changes. You continue with your ROU asset, continue with your ROU liability, and you will then will record that as your lease income on an ongoing basis. So original lessee then continue to account for the lease liability and the ROU asset on the head lease like any other lease. If the total carrying amount of the ROU asset on the head lease exceeds, right, the anticipated sublease income, so this is like an asset impairment, depending upon the contractual arrangement that for what period you have leased out, then what is the economic benefit you can generate for the remaining period. So you'll have to evaluate an impairment as a criteria, right? So moving forward, so further try to understand this with the help of an example. Okay. So entity ABC, which is the original lessee, the intermediate lessor, right, leases a building for 5 years, right? The building has an economic life of 40 years. Okay. Entity ABC sublease the building for 4 years. Okay, how should the said sublease be classified by entity ABC? So if you look at here, what we are saying is that I've leased it, lease term, right, was 5 years. Okay, and I have subleased it. Okay, sublease term is 4 years. Okay, and economic life of the building is 40 years. Okay, so the question here is this: what is the classification of the sublease? And the criteria for evaluation is this has to be evaluated with reference to the intermediate lessor. So what were the criteria for assessing a finance lease or an operating lease? That is there a transfer of ownership? Since I'm not the owner, I can't transfer, right? Is there a bargain purchase option? I can't give that purchase option because I'm not the owner. The only two criteria in a way which becomes relevant here is that am I leasing it for substantial period of the life, and am I subleasing it for the substantial value which I otherwise was carrying in my balance sheet with reference to the value of the ROU asset. So if the value is substantial with reference to my carrying value of the ROU asset, or if the life for which I'm leasing it, subleasing it, is relative to the life I was entitled to, which is in this case is 5 years versus 4 years. That means substantial period I am subleasing it. So essentially this looks like a case of a finance lease, right? The sublease is classified with reference to the ROU asset in the head lease and not the underlying building of the head lease. Hence, when assessing the useful life criteria, the sublease term of 4 years is compared with 5 years. And accordingly may result in the sublease being classified as a finance lease. So here, this looks like it's a finance lease because when you compare 5 years with 4 years, looks like it's substantial, more than 75%, right? Almost 80%. So that's why possibly the answer here is that it's a finance lease. Okay. Let's look at another example when the sublease is classified as a finance lease. Okay. So head lease, an intermediate lessor enters into a 5-year lease for 10,000 square meter of office space, the head lease with entity XYZ, the head lessor. Okay. Then I'm doing so there was a 5-year lease agreement, and then I'm doing a sublease at the beginning of year 3. At the beginning of year 3, 2 years that means have passed. The intermediate lessor sublease the 10,000 square meter office space for the remaining lease term for remaining 3 years. So that means when I'm leasing it, essentially I'm leasing it like a finance lease, right? How should the said sublease be classified and accounted for by the intermediate lessor? So we have to do the evaluation. Essentially, as I said, useful life. So I had remaining useful life or remaining life I was entitled for is 3 years, and I have leased it for 3 years. That means I've substantially transferred the risk to the lessee, right? The end user. So essentially that becomes a finance lease. The intermediate lessor classifies the sublease by reference to the ROU asset arising from the head lease. The intermediate lessor will classify the sublease as a finance lease, having considered the requirement of, so it is actually a finance lease because I'm going to look at it with reference to remaining life and value. Okay, and in the information I have, the life was 3 years and I have leased it for 3 years. There's no other judgment actually which is required. So it's a sublease. Now, how do I do accounting for this? I'm going to de-recognize the ROU asset and I'm going to recognize the investment in the sublease, which is nothing but my present value of the future lease payment, which I am now entitled to receive. The difference between the ROU asset and the net investment is taken to the profit and loss account, and there's no change in the lease liability, right? Retains the lease liability and the way it was. Now, when you look at, during the term of the lease, the intermediate lessor will recognize what? The interest income on the net investment in the lease, right? There will be unwinding of that interest income, and there will be interest expense which will come. So you essentially, you will stop recording the, there will be no amortization, right? There will be no amortization charge on an ongoing basis. You will simply have, because you are no longer using it for your own business, you've subleased it. So essentially you will have interest income and you will have interest expense. Okay, you will stop doing the amortization, right? Finance income on the sublease and interest expense on the head lease. Okay. Now, let's look at another example where the sublease is classified as an operating lease. Then how do you deal with this? Okay. So if the sublease is classified as an operating lease, okay, so an intermediate lessor enter into a 5-year lease for 10,000 square meter office space with entity XYZ, all right? The head lessor, at the commencement of the head lease, the intermediate lessor subleases the 10,000 square meter of space for 2 years, okay? So my original was 5 years and I am leasing it for 2 years, okay? At the commencement itself. That means, is this substantial period? No, right? It's only 40%. 5 year was my original period and I'm leasing it for 2 years. So this in a way represent only 40% of the useful life of which I'm entitled for. So that means it's not a finance lease. Looks like it's an operating lease, right? So now, if it's an operating lease, how do I deal with this? So from an intermediate lessee perspective or a lessor perspective, you had ROU asset for those 5 years and a liability, and then you were doing the amortization and recording the interest expense, right? And there was a cash flow in terms of payment of your rentals. Now, what you will do, the operating lease, the intermediate lessor essentially will, continue to record the rental income. Whatever I'm going to receive, that I'm going to record as a rental income. So that is it, right? Possibly nothing else in a way looks at it, other than, of course, I may have to look for some, is there any impairment or other kind of thing I need to be worried about. So the intermediate lessor classify the sublease by reference to the ROU asset arising from the head lease, okay? The intermediate lessor will classify the sublease as an operating lease. Having considered the requirement of Ind AS 116, that is one of the criteria of useful life, for a lease to be classified as a finance lease. And since it is not satisfied, classify the same as an operating. So again, you're going to look at, as I said, useful life, or you're going to look at the value, okay? Value with reference to ROU asset, okay? So again, what I was paying for 5 years, assuming you will not be able to recover substantially in 2 years, right? So, and anyway, that information is not available in the question. So when the intermediate lessor intend to sublease, the intermediate lessor will retain the lease liability and the ROU asset. So nothing in a way changes, both in a way continues the way it is. Now, what else I need to do? The intermediate lessor will recognize the depreciation charge. I'll continue to record. I'll record the interest and I will record lease income from the sublease. Okay. What will sublessee will do? Sublessee will record the ROU asset and the ROU liability. Sublessee will also do an ROU asset and ROU liability, right? For a 2-year period from that perspective. The sublessee will also record the ROU asset and ROU liability like a normal operating lease lessee. So whatever rental I've committed to pay, that at the present value of that discounted for 2 years, right? That becomes my asset and the liability from that perspective. Okay. So moving forward on the sale and leaseback. So now we've talked about how do you deal with the a sublease, right? Now I'm going to talk to you about sale and leaseback. And sale and leaseback, remember what I said, right? Sale and leaseback is, let's say I am the owner of the asset, and I have sold this to XYZ, okay? And then I've decided to lease it back, right? And I may decide to lease it back for maybe the substantial period of the useful life of that asset, or maybe for 3 years, 5 years, depending upon my need, right? The commercial consideration. So depending upon the facts and circumstances, we need to evaluate the appropriate accounting. So essentially, what happens is in a sale and lease back, the first question you need to evaluate: is there a sale, right? Is there a sale? Is there a substantive sale? And that evaluation you will do based on the substance, based on Ind AS 115 criteria. And I hope you remember what are those criteria, which is to say that first to determine the contract, right? Identify the contract between the buyer and the seller. In a way, are they counterparties? And then determine all your performance obligation under the contract, then determine the contract consideration, and then allocate the contract consideration to each of the performance obligation, and then record revenue as each of these performance obligations are fulfilled. And again, the very, very essential test in terms of the the performance obligations are fulfilled, that in case of sale of goods, is there a transfer of control, right? When you're looking at sale of goods, is there a transfer of control, right? So that's an essential test which needs to be met from a revenue recognition perspective for a sale to be concluded. If it is not a sale under Ind AS 115, then essentially we are looking at this then under Ind AS 109 as a financing transaction. So that's what we need to evaluate, right? So a sale and leaseback transaction involve the transfer of an asset by an entity, all right, to another entity, and the leaseback of the same asset by the seller lessee. Sale and leaseback transaction would no longer provide lessees with a source of off-balance sheet, because whatever rental I need to pay. So why we were doing this sale and leaseback? Because the when you were leasing it back, in assuming it was leased back as like an operating lease, then there was no capitalization, right, of the operating lease under the Ind AS 17 model. But now under Ind AS 116, even if you leased it back for say 5 years, you have to capitalize the rentals of what you are obligated to pay, including the renewal options and so on and so forth. So the overall objectives are defeated, but I know we're not seeing that the transaction is still happening, right? The companies are still doing it, because still end of the day it's a source of financing, right? It's a source of financing. Though the balance sheet advantage has been done away with, but still it is a source of cash flows, right? From original seller perspective, you get the immediate funds, right? Which then essentially you can deploy it for any other purpose, and then you have to pay rent for the usage of your property, right? Further, both the seller lessee and the buyer lessor are required to apply Ind AS 115, as we talked about, to determine whether to account for a sale and leaseback as a sale and purchase of an asset. Okay. So how do you determine whether the transfer of an asset is a sale? So we will apply the requirement of Ind AS 115, whether an entity satisfy a performance obligation by transferring control, right? So essentially two possibilities. If control is paused, then it is it accounted for a sale or purchase and a lease. Okay. If the control is not passed, then it is nothing but a financing transaction. Here you then account for it under Ind AS 109. Here you will account for it under Ind AS 115. And then Ind AS 116. Here you are accounting for under Ind AS 109, and you may retain, right, the original asset in a way, depending upon whether derecognition criteria are met or not. Okay. Now, none of the indicators mentioned under 115 individually determine whether the buyer lessor has obtained control. So, essentially, what we're trying to say is that when you are trying to apply Ind AS 115, you have to look at the substance of the arrangement, right? The existence of a leaseback in isolation does not preclude, just because there's a leaseback does not mean that there is no sale, right? Because a lease is different from the sale, right, or purchase of an underlying asset. Okay. However, the key is that if there is a repurchase option, right, if there is a repurchase option, at the end of the lease back and lease term, then you start wondering, is there actually a transfer of control? Because you transferred it and then you leased it back, and then end of the lease term, if you get a right to buy, essentially that asset in a way never left, the control of the original seller and now the user of the asset as well. So essentially then it sounds like it's a financing arrangement, right? And you haven't transferred any risk or reward of the asset to the financer or the seller lessee, in a way from that perspective. Okay. So we need to understand this, look at this more at a substance. You apply in DS 115 with objectivity, and then in a way conclude that is there a sale or there is not a sale. If the answer to that is yes, then you want to deal with this like a sale and then lease back of the asset. The accounting is slightly complex, right? In terms of how do you record how much to be recorded on disposal as a gain or a loss or a continued obligation and so on. We'll try and understand all of this in a way with the help of an example. Okay. So assuming there is a transaction in which the asset is a sale, the seller lessee shall measure the ROU asset arising from the lease back at the proportion of the carrying amount that relates to the right of use retained by the seller lessee. I think this is where it is very, very important, and we will try and understand the computation philosophy with the help of examples. So the seller lessee shall measure the ROU asset, because I'm going to now record the ROU asset from the leaseback at the proportion of the carrying amount that relates to the right of use retained by the seller lessee. All right. Thus, the seller lessee will de-recognize, because I am anyway sold this asset, so I'm going to de-recognize the original asset and recognize the gain or loss, if any, that relate to the right transfer to the buyer lessor. If there is a gain or loss, I'm going to record that. Now, from a buyer lessor perspective, I'm going to in a way record the asset as a purchase, right, under say Ind AS 16 or any other let's say under investment property, for example, under Ind AS 40. So I'm going to record this as an asset first, as a purchase, and then I'm going to record that I have leased it, right? I have leased it to you in a way, and deal with this, that whether it's a finance lease or an operating lease from a buyer lessor perspective, apply the lesser accounting requirement under Ind AS 116 from that perspective, right? So I have to apply that lesser accounting from a buyer lessor perspective. I think accounting is not that complex, but though we will try and understand it. From a seller lessee, there is it's not very intuitive because of the proportion of the carrying amount that relate to the right of use retained by the seller lessee from that perspective. So let's just try and understand this. Okay, with the help of an example, we will try and understand this with the help of an example. Okay. So here an entity sells a building to another entity for cash of INR 30 lakhs. Immediately before the transaction, the building is carried at a cost of INR 15 lakhs. Okay, so I've sold it for 30. My carrying cost was 15 lakh. At the same time, the seller lessee enters into a contract with buyer lessor for the right to use the building for 20 years. Okay, so there's a sale and lease back for 20 years with annual repayments of 2 lakh rupees as the rental. Now, the terms and conditions of transaction such that the transfer of building by the seller in a way transfer satisfy the sale under Ind AS 115, that information is given. The fair value of the building, which is sold on the date of sale, is actually 27 lakhs, okay? Not 30 lakhs. I sold it for 30 lakhs, but the fair value was only 27 lakhs, okay? Initial direct cost, if any, are to be ignored. The interest rate, which is implicit in the lease, is 12%. That information is also given. The buyer lessor classify the lease. The buyer lessor classify the lease as an operating, because for, essentially, I believe the life of that could be 40 years, and I'm leasing it back only for, in a way, 20 years. Okay, so the buyer lessor has done that assessment. It's an operating lease. So how should the said accounted transaction be accounted for in the books of the seller as well as the buyer? Okay, so let's just try and understand the solution. Okay, so first I'm going to compute the financing. See, remember the fair value of the building is 27, but I've sold it for 30 lakhs. So 3 lakh rupees is step one to determine as the additional financing component. That's I paid, the buyer has paid over and above the fair value. Okay, so buyer should actually record the asset only at fair value, which is 27 lakhs. If he's paid more, then that is another receivable, right? On which you are only supposed to record the interest income. You're not supposed to record asset over and above its fair value, the initial recognition test, right? So the 3 lakh rupees in a way is what the buyer will record as a financial asset, and the seller is also in a way was obtained the additional financing. So in a way, my sale value should have been 27, but it is actually 30 here. So I'm going to say this 3 lakh rupees is additional financing component. That's my step one. Okay, fairly simple, right? Now I'm going to look at step two in a way to calculate the present value, right, of how much I need to make a payment. Okay, so I need to make a payment for 20 installments of 2 lakh rupees each at the rate of 12%. Okay, so if I were to discount the present value into amount of 14 lakh 94,000, 14 lakh 94,000, which is the entire 24 lakh which I need to pay, which is 2 lakh into 12, sorry, 2 lakh into 20, right, is 20 I need to pay. 2 lakh into 2 lakh into 20, which I need to pay. All right. So step one was to calculate the additional financing component. The step two, I'm going to calculate the present value of the annual payment, which is I'm making a 2 lakh for 20 years, right? That's what I need to do, and then if I were to discount it at the rate of in a way 12%, I'm going to get 14 lakh 94,000, right? That is what I'm getting, of which 3 lakh in a way relates to the additional financing component. So 14 lakh 94 minus 3, in a way 11 lakh 94,000 is what I'm paying for the lease component. Okay, so now this is where it is important to compute the proportion of annual lease payment with reference to the asset value. Okay, so that's the computation we need to look at doing. Present value of lease payment was 14 lakh 94,000. Then this 3 lakh is the additional financing component. So now, so what, and I'm making a payment of 2 lakh rupees. Okay, now this is where this is important for you to get right, right? 40,160 is actually relate the payment out of this 2 lakh. 40,000 is I'm making payment towards this 3 lakh, which is computed as C is equal to E, which is 2 lakh. Okay, 2 lakh into B, which is 3 lakhs. Okay, divided by 14 lakh 94,000. Okay, then you get to 40,160. So essentially 40,000 is nothing but the repayment of the financing which you obtain, which is 3 lakh for over a 20-year period, which I need to repay. And the 1,59,840 is the actual rental which I am paying at present value in relation to the 1,59,840, which is I'm paying that gross value, not at the present value, with reference to the 11,94,000. Okay, so that's how you compute the proportion of the annual lease payments. Okay, 1,59,840. Then we move to um, step 3, which is computation of ROU asset for the seller lessee for next, in a way, how much I need to record. So it's not intuitive, right? The answers are not very, very intuitive. At the commencement, seller lessee will measure the ROU asset arising from the lease back of the building at the proportion of the previous carrying amount of the building, at the proportion of the previous carrying amount that relates to the right of use retained by the seller lessee, which is not 30 lakhs. Okay, 27 was a fair value. That is what I need to look at. What is my value of the rental which I need to pay? Again, it is 11,94,000 in relation to 27 lakh, not for 30 lakhs, which is 14,94,000, because 3 lakh is nothing but the additional financing component. Okay, so now if you apply A by B into C, okay, so this proportion with reference to this, you get 6,63,333 as my ROU asset. Okay, as the ROU asset. Okay, and then I need to record the gain, right? So my carrying value, remember, was 15 lakh, right? So, and my retained value is this much. So how much is my gain on the sale, right? So I'm going to record the gain that relate to the right transfer to the buyer lessee. So 27 lakh, and then the carrying value was 15 lakh, the rental which I need to pay, all of this information is available. So vanilla gain on sale is 12 lakh. Okay, 12 lakh. Now this 12 lakh is not you get to record in the P&L. What you get to record in the P&L is 6,69,333. Okay, now relating to the right which is retained, okay, that gain is not allowed to be recorded. Okay, so E is equal to D by A into C. What is D? Which is 12. 12 lakh, okay, 12 in a way divided by 27 into C, which is what I need to pay. Okay, 11.94. Okay, that number comes to 5,30,000. Okay, that number is what is I've retained as an profits are retained in a way. That benefit essentially you will get over a period of time by way in a way of lower amortization charge. Okay, because I'm not recording the entire profit, so to say. So the profits relating to right which is transferred is 6,69,333. So now how do I record this over a journal entry? So when you look at a journal entry for this whole thing, I've received cash, simple, 30 lakhs. Then I'm going to record the ROU asset, which was 6,63,333. That's on the debits. Then on the credits, I'm going to de-recognize the building at 15 lakhs, right? That was my carrying value. And I'm going to record the lease liability of 11,94,000, right? Then I'm going to record the gain on rights transfer, which is 6,69,333. And I'm also going to record the financial liability of 3 lakh rupees, which is the financing component, which is over and above from that perspective. Now, when you look at it from a buyer lessor perspective, okay, so here, what is the buyer is going to do? Is going to record the asset first, okay, record the building at 27 lakhs is debit. Okay, and then how much I paid cash? I paid a cash of 30. So I'm going to record another financial asset of 3 lakh, which is my entitlement for 20 payment of INR 40,160 discounted at the rate of 12%. So that gets to 3 lakhs, and I'm going to record cash outflow of 30 lakhs. So from a buyer lessor, the accounting is far simpler. Okay, essentially you are doing accounting for recording asset at present value, at fair value, which is 27 lakh, and recording your right to receive cash for the additional financing, which is 3 lakh rupees, which you will accrue over a period of time. Now, after the commencement date, you will record a rental income of 1,59,840, and you will record an interest income on this 40,160, right? You will record the interest income. So I'm going to receive the payment settled 3 lakh, and there will be an interest revenue. So there will be interest revenue in relation to this, right? 40,160 at the rate of, in a way, 12%. So in year one, on 3 lakh at the rate of 12%, you'll follow a simple effective interest rate method. So in year one, your interest income actually will be 36,000, right? Which will keep on going down, and you will simply keep on adjusting. So that's how the buyer lessor will do the accounting. So I hope this whole accounting is clear to you, right? The seller lessor accounting as well as the buyer lessor, it's not intuitive. So especially because when you have to spend time to understand how do I need to compute the proportion, okay, of the interest, even though it's a sale, you don't get to record the entire income of 12 lakh rupees, right? Which was 27 lakh was the fair value. My carrying value was 15 lakh. You don't get to record the entire 12 lakh rupees as a profit. You only get to record what the interest which has been transferred, because you retained an interest, which is this 11 lakh 94,000, right? So a proportion of 11 lakh 94,000 with reference to your carrying value to the fair value, that is what is in a way retained. Balance in a way is your profit, right? Balance is the profit which you get to record. And then it's fairly simple. Cash is simple. Then what you de-recognize, which is 15 lakh, is simple. What you record, which is the ROU asset, which is the value which is retained, right? ROU asset is not 11 lakh in itself. ROU asset is the 6 lakh, okay? The liability is 11 lakh because that is what I need to pay, and that's where your amortization in future period comes down, right? And that's an important thing which you need to understand, your amortization cost. So if I were to just go back and try and help you understand this further, right? Here in this example, so this is going to get amortized, right? This will be amortized in my future period, even though my cash flows are linked to this, okay? My cash flows are, I'm going to make this payment and I'm going to make this payment. The P&L charge will be different, okay? P&L charge will be nothing but I'm going to amortize this 6,63,000 over a 20-year period, right? So that's the important thing for you to, in a way, understand and remember, okay? So that's, in a way, gives us the perspective on how do I account for the seller lessee as well as from a buyer lessor perspective. So now if the transfer of an asset is not a sale, it is financing in a way, then from a seller lessee, you continue to recognize the transferred asset and shall recognize a financial liability, which is equal to the transfer proceeds. And you apply the principles of Ind AS 109. And you will record, of course, the interest cost, and you will continue to record the amortization or depreciation on the original asset. From a buyer lessor perspective, you will record that as a loan, which is I have given, right? Financial asset equal to the transfer proceeds as receivable. Financial assets will be accounted for under Ind AS 109. Okay. So let's quickly, in a way, summarize what we've talked about from a sublease perspective. There's an intermediate lessor, and you do the evaluation. Or there's original lessor, there's an intermediate lessor, and then the end user, the lessee, and you will do the evaluation of the accounting for original lessor doesn't change, right? The only accounting where I'm more focused is the intermediate lessor, and there I'm going to do accounting with reference to the finance lease or an operating lease, and this assessment I do with reference to the rights and obligations which are available with the intermediate lessor. So if I have a right of asset for 5 years and I've given it for 4 years, that means a finance lease. If I have a right of asset for 5 years and I've given for 2 years, that means an operating lease, okay? I'm not concerned with the original asset life or not. I'm concerned with my rights and obligation as part of the original lease agreement, right? So lessor, in a way, head lease, and then there's an intermediate lessor, the sublease, and then no change accounting with the head lease. Sublease is classified as a finance lease or an operating lease, right? So all of that I need to look at. And from a sublessee perspective, accounting is again simple. Now, on a sale and lease back, we looked at the whole nuance of sale and lease back, slightly complex, I would say, in terms of the computational aspect, but the principle is fairly easy that I am the owner of the asset, I've sold it to another party, and then I've kind of taken that asset back to use it, right? Again, these are two independent in a way contracts. So I have to evaluate whether it meets the test of a sale under Ind AS 115 model. In a way, is there a transfer of control, right? If the answer to that is yes, I'm going to record that as a sale. Then the question comes, how much is the gain I need to record? The gain on sale is actually with reference to the proportion of the interest which has been retained, right? So is the whatever is the transfer, that is that portion you're going to go to record as gain. And we saw the example, the way all of this needs to be dealt with, right? So from a seller lessee perspective, there could be a gain or it could be a financing. All of that is what I need to deal with. From a buyer lessee, I could record the asset and then record the subsequent accounting for your lease receivable under the Ind AS 116 model, right? So that's possibly is what the whole thing is what we wanted to talk to you about, Ind AS 116. And when you look at the transition, since it is a new standard, right, there are transition approaches. There are multiple transition approaches as provided for in the standard. So it's applicable for annual periods beginning on or after 1st April 2019. And the date of initial application is the beginning of the annual reporting period in which an entity first applies Ind AS 116. So there are three approaches: full retrospective, modified retrospective option 2. So there are in a way three approaches. When you look at a full retrospective, means you apply as if the standard was always in force for all leases which are outstanding at the date of the in a way transition, including the comparative period. Okay, so in the retrospective, you also in a way going to look at Ind AS 8, the accounting policy. So you present a third balance sheet. So you will, let's say if you're doing 2019-20, you are doing 18-19. So you want to apply here, and also you will apply as of April 1, 18. Okay, April 1, 18. So essentially you end up drawing up three balance sheet and apply this all the principles, the determination of ROU. Essentially you determine then your ROU asset, right from the original date of those leases. So leases which are outstanding on April 1, 18, essentially you will go back in time and then you will compute their ROU asset at their original inception date, and the liability, do the amortization, do the interest unwinding. All of that is what you will do, and then you will compute what is your accounting impact on your retained earning on the date of transition, which is April 1, 18, and then what's the P&L balance sheet impact on 18-19 and 19-20, and so on and so forth. That's how in a way you will do with this. We have experienced that most of the companies have actually followed modified retrospective approach. Okay, now in a modified retrospective approach, what do? You don't go back to all the years in a way. So what you do is modified retrospective. You don't restate the previous year. Okay, you only then focus on FY 19-20. Okay, the current year, so to say, and you make the changes at the beginning of April 1, 19. And what do? You look at the carrying amount as if Ind AS 116 had always been applied, right, since the commencement date, but using a discount rate. Okay, using a discount rate based on the lessee incremental borrowing rate at the date of initial application difference. So here you get a benefit of the discount rate. Okay, so the discount rate based on the lessee incremental borrowing rate at the date of the initial application. Okay, and as if you were always applied this. Okay, as if you were always applied. So the benefit of this modified retrospective, so if you are doing, let's say 19-20 and 18-19, right, then you only do this here, right, and you make the opening balance sheet adjustment here. Okay, as of 1st April 19, you don't touch for 18-19 or your April 1, 18 opening balance sheet. Okay, and the P&L benefit, if any, that gets accounted for in a way from that perspective. So Nitin. All right. So alternative two here is essentially then there will be no adjustment. Alternative two is the most simplest transition option. In a way, your ROU asset essentially will equal to your ROU liability on the transition date, subject to if there is then some advance or other things you're paid. If you just kind of take that out, your ROU asset will equals to ROU liability. So that's where the alternative two is, again, a lot of companies have applied this, but some companies have applied this as well. Alternative one, the biggest impact was, or the benefit of alternative one, as you can imagine, the accounting for leases or the operating leases under the Ind AS 116 model, the accounting charge is front loaded. So in a way, if you're doing the retrospective accounting, so a significant portion of accounting charge actually can be recorded as part of adjustment to opening retained earnings. All right. And so your future PNL will look better. Your future PNL may look better, provided you consumed a portion of your existing lease arrangements, so on and so forth. So there was some scenario planning which a lot of companies did in a way to look at Ind AS 116 transition approach. And you have, so of course you have to look at if there are any onerous contract. There's some practical expedients also were available as part of the transition. So discount rate, you can apply a discount rate to a portfolio of leases with similar characteristics. For onerous contract, you may look at evaluation of that under Ind AS 37, as opposed to doing an impairment review under the Ind AS 36 model. Short-term leases, remember the short-term lease, the 12-month exception is for lease with an original term of 12 months. But here, if the remaining lease term was also 12 months, right, less than 12 months, then you were allowed to take the short-term lease exemption for the transition. Initial direct cost, you could have possibly ignore the additional direct cost, as part of practical expedient. Hindsight, you're also allowed to use the hindsight while looking at the renewal options, right? That now, let's say you made up your mind, so instead of treating all such renewal decision as a modification, so whatever your renewal decisions which are now there on the date of transition, you were allowed to in a way factor that in while doing the transition in a way computation. Okay. So lots of practical experience which were available. Now, if there are leases which were previously classified as operating leases, right? If there are leases which you had, so then you need to allocate the consideration between various components of leases, which is the lease component and the non-lease component, right? And we talked about how do you do this based on the relative methodology, relative fair value methodology, right? Based on the relative standalone selling price. That is what you will in a way do. You will determine the fair value of the lease component, fair value of the non-lease component, determine the total consideration, determine the discount now which you received, and then allocate the discount to each of these components and then do the accounting accordingly. Though the transition principles are not very detailed around this, but this is what we believe is that what you need to follow. When you look at again modified retrospective approach for leases which were there as finance lease in your balance sheet, okay, so essentially whatever was there as finance lease and the lease liability, you just kind of move them or reclassify them as ROU asset and the liability. There is no accounting change, there is no impact on that. So they were classified as finance lease under Ind AS 17. That their carrying amount at the date of initial application shall be the carrying amount of the lease asset and the lease liability before that date measured by applying Ind AS 17. So for such leases, lessee shall account for the ROU asset and the liability from the date of initial application, right? So there's no, in a way, change. Okay. Now, when you look at from a lessor perspective, right? So now from a lessor perspective, there is substantially no impact on transition. Okay. Other than that, you apply on a prospective basis that straight lining of lease rental, which we talked about, right? You're not required to make any adjustment on transition for lease, which is a lessor, and account for those lease under Ind AS 116. Okay. You've got to reassess subleases. If there are subleases, right, that is required to be reassessed. So this is for intermediate lessor, right? So if you are an intermediate lessor, then you are required to reassess based on operating of finance, based on the principles we talked about with reference to essentially two conditions, right? Which is the value or the life, right? Is what you need to look at. And for subleases that were classified as operating leases, applying Ind AS 17, but now they meet the finance lease, you will have to do the computation, transition, gain or loss. All of that is what is will be required. Now, moving forward to talk about the presentation and disclosure. So, from a balance sheet perspective, you're going to record the ROU asset and the liability. So, ROU asset is presented separately from other asset. It is like an intangible asset, separately from other owned assets, together with other assets if they are owned, with disclosure on the balance sheet. And then are presented as investment properties. If there are investment property, then you present them as investment property. Lease liabilities, they are separated from other liabilities or together with other liabilities with disclosure in the balance sheet line item. So either you can do changes in the face of the balance sheet, or you can make this as part of a schedule, as part of disclosure. So you have to separately, in a way, disclose, right? What is your ROU asset? What is your liability? So on and so forth. Similarly, from in the P&L perspective, you will have, as we've been talking, you will have the amortization depreciation charge, right? And also you will have the in a way the interest expense. Both of them are presented separately. One is presented after EBITDA, and the other one is present. So if you have revenues, and then I have expenses, and then I have GP, and then I have SG&A, right? Then I have EBITDA, right? EBITDA, right? And then I have depreciation. Then I have what is called as EBIT, and then you present the interest, and then you have EBT, right? So that's how you do, and then you have taxes, then you have net profit, right? That's how you will make the presentation, okay? So the interest expense is a finance cost, which I have also explained is also eligible possibly for capitalization if you have a qualifying asset, right? On the right hand side of the balance sheet. From a cash flow perspective, how do you present? In the cash flow, it is financing activity, the principal portion of the lease liability, which I'm paying, right? That's financing, as well as the interest also gets charged to the financing. What goes into operating? If I've taken a short-term lease, whatever rent then I pay goes into operating lease, and then low value and variable lease payment, which are not capitalized as a as a right of use asset or a liability, then that also goes as part of your operating lease. Then from a non-cash activity, you also need to make a disclosure that this much is the asset or liability is what you have entered into at the commencement, right? Right of use asset and liability. All right. So tons of disclosures, right? Disclose, and disclose. So related to financial position, you whatever additions, the carrying amount, the lease liability, the maturity analysis, right? Statement of P&L, the depreciation charge, the interest expense, the short-term leases, the low value item, variable lease payments, subleasing right of use, gain and loss from sale and lease back, all of that. And then of course cash flow also you need to disclose. Tons of disclosures. So disclose, and disclose, right? So then you look at it from a lessor perspective. So I'm going to look at my finance lease or operating lease, right? Depending upon that, again, I got to disclose the asset in the balance sheet and present them as a separate line item. Net investment is presented again as a separate based on current and non-current, depending upon my right to in a way receive. So operating lease asset anyway is there, and then there's a right to receive cash flows. That is in a way gets disclosed that some of these assets being leased to others, right? So I need to disclose that. Then for finance lease, I also need to make a disclosure of the gross investment and the present value of the MLP. I need to make that disclosure, whatever my unearned finance income, unguaranteed. So tons of disclosures. Again, additional disclosures for my operating leases, and the contingent rent, which also is recognized, that also needs to be separately disclosed. Essentially, this will come in a variable model, right? And the description of the lessor material leasing arrangement, all of that. So lots of disclosures, lot of disclosures. Essentially, all the substantive features, the terms, amounts, all of that needs to be disclosed from a. And whenever you think of a disclosure perspective, think of it from a balance sheet, P&L, cash flow perspective, right? So what should go into my balance sheet, what should go into my P&L, what should go into my cash flow, and then how do I capture it from a a schedule to notes perspective, and then are there some of the features which are important. So whenever a disclosure under Ind AS is basically is this information relevant from a user of the financial statement perspective, right? Again, from a sublease perspective, you got to disclose that what all you have leased out, which and you do a gross presentation, because there is depending upon if it's a finance lease or an operating lease, all of that you need to in a way make disclosures. Okay, so disclose, and disclose, right? So all the disclosures. All right. So please read all of them and just familiarize yourself with all the disclosures. So in a sale and lease back, again, I need to disclose that how much is the gain and loss, and then the reason for sale and lease back, the terms and condition, and the payments not included, and then the cash flow effect of sale and lease back. All of that is what I need to disclose. So tons of disclosures. Again, disclose from a lessee perspective, from a lessor perspective, from a sublease perspective, from a sale and leaseback perspective, from a transition approach perspective, and then when you are thinking of disclosure, think of it from a balance sheet perspective, P&L perspective, cash flow perspective, with reference to the lessor, with reference to the lessee. All of that is what needs to be in a way provided to the user of the financial statement, provided the information is material, information is relevant. Okay. Now we will quickly try and understand some differences between Ind AS and IGAAP on this. And this is a new standard. So we have Ind AS 17, which has been superseded by Ind AS 116, and we had accounting standard 19, right? So scope and coverage, largely other than land, right, is covered by standard AS 19. The land is excluded. Okay. Now, when you look at the definition of lease, broadly similar. There's some more kind of color to this. So, in a way, conveys the right to control the use of an identified asset, where it says a agreement where the lessor conveys the lessee in return for a payment or series of payment. In a way, the word control has not been used here, right? In this, the word control is, but we. In substance, not a whole lot of difference is what we experience in terms of the definition of lease, right? Though there could be some nuance, which may come up if you were to really look at some highly complex transaction. Lease modification, you have to assess this. A lot more guidance as to whether lease modification is a separate lease or it's a continuation of the same lease, and we remember we talked about this, that whether you are getting the increase in scope with a separate standalone price is what you're paying, and then you account for them, or if there's a decrease in scope, there could be a gain or a loss also which may come through. Then you look at a classification, substantial change here from a classification perspective. It's a single recognition model from a lessee perspective under Ind AS, under AS 19. It was continues to be finance lease and operating lease, right? So lease exemption, we have here some exemption for short-term lease and for low value item. We don't have such exemption under AS 19. I'm not trying to compare it with Ind AS 17, right? You have the information, but I think Ind AS 17 and AS 19 were largely similar. Okay, Ind AS 17 and AS 19 were largely similar, whereas the substantial difference is now there between AS 19 and Ind AS 116. In terms of lease incentives, though guidance, the application was pretty much similar. The incentives are recorded as a reduction from the ROU asset. Okay. When you look at the sale and leaseback, again, lots of guidance, and how much gain to be recorded, the sale has to be recorded. All of that is more comprehensive, more detailed in Ind AS 116. In a way, as compared to AS 19, and the accounting outcomes can also be different. So initial direct cost, again, we have to capitalize in a way the initial direct cost under Ind AS 116 model. So a similar outcome possibly you may get under AS 19 as well. Moving forward, from a finance lease, you can recognize as expense immediately or allocate it against the finance income over the lease term. And the accounting and presentation in financial statement by lessee, when you look at again, lots of guidance, for short-term leases which exist, and there is no such guidance, under AS 17, AS 19 model. So again, lessee will recognize asset and liabilities for all leases a term of more than 12 months, unless the underlying asset is of low value. Under operating leases, there's nothing which was recorded, right? It was an off-balance sheet arrangement, so that's been done away with. So I think with this, we're almost at the end, and we will have a few more questions for you and solutions, which my colleague Amit is going to record it for you. But I think the whole thing which you need to remember, I think on Ind AS 116, that it's a lessor and a lessee. There has to be an asset, a tangible asset, which is a property, plant and equipment, land and building, furniture, fixtures, so on and so forth. And now there is a transfer of that asset in a way from a usage perspective, or which I have retained control, and there's an exchange of consideration, and I am going to generate future economic benefit. There are several things which I need to know, that what is the lease term, what is the lease rentals, what are my rights and obligation, and then for us to demonstrate control, what, when, how, where, all of that is what you need to remember. For to say that this asset is explicitly or implicitly identified, that means there should not be any substitution right which is available to the lessor. If there is a substitution right, that has to be only an exception, not by the rule, and tons of other things in a way which we talked about. So I hope all of this is going to help you in terms of understanding this topic better, and feel free to write to us, and we'll be more than happy to help with any of your doubts, questions, clarifications. So thank you very much.